December 25th, Christmas Day, a day when global markets are quiet, trading desks are empty, and most of the world assumes that nothing important is happening. Families gather, screens go dark, headlines slow down, but history has a habit of moving when no one is watching. On Christmas morning, something highly unusual began appearing across major bullion dealer websites. Retail buyers logging in to purchase silver coins or bars were met with messages they did not expect to see on holiday. Out of stock. Sales temporarily halted. No new orders being accepted. Not just one dealer, not two, multiple major sellers. At the same time, there were no breaking news alerts, no financial headlines, no emergency statements. Just a quiet, synchronized pause in physical silver sales on the least active market day of the year. And that silence was exactly what made it important. When nothing is supposed to happen. Christmas Day is what professionals call a low liquidity environment. Price movements, if they occur, can be exaggerated or deliberately avoided. That's why most firms play defense on holidays. They don't experiment, they don't improvise, and they certainly don't shut down profitable sales unless something is wrong. So when silver dealers collectively stopped selling, the question wasn't whether this was a holiday inconvenience. The real question was, what risk were they avoiding? Because in financial markets, actions taken during quiet periods often reveal more truth than actions taken during chaos. Silver is not just another commodity. Silver occupies a unique position in the global system, a hedge against currency instability. Unlike gold, which is mostly hoarded, silver is consumed. Electronics, solar panels, defense systems, medical equipment, all depend on physical silver moving through supply chains. That makes silver extremely sensitive to stress. When something breaks in silver, it rarely stays contained. And on Christmas Day, something didn't just strain, it paused. The first warning was availability. Price charts did not explode. There was no dramatic spike on screens. Instead, the warning appeared in a far more important place: availability. History shows that before prices revalue, access tightens first. This has happened repeatedly. Before major gold repricing events, before commodity supply shocks, before currency confidence breaks, markets often whisper before they scream. And this time, the whisper came in the form of temporarily unavailable. Why this was not a coincidence. It would be easy to dismiss the event as a holiday logistics issue, staffing shortages, delayed shipments, inventory counts. But coincidence doesn't explain synchronization. Independent dealers do not all pause sales simultaneously unless they are responding to the same pressure. That pressure could only come from one place: price uncertainty. Dealers don't fear demand, they fear selling at the wrong price. And Christmas Day created the perfect conditions for that fear to surface. Low liquidity, high consequences. In thin markets, price discovery becomes unreliable. Futures contracts can move sharply with very little volume. Hedging becomes imperfect. Replacement costs become unknown. For a bullion dealer, this creates a dangerous scenario. Sell physical silver today, hedge at a paper price, and wake up to a market that has moved against you before liquidity returns. On normal days, dealers manage this risk easily. On Christmas Day, they chose not to. That choice tells us something critical. Confidence in current pricing had weakened. The media said nothing, and that mattered. There were no mainstream reports, no analyst notes, no urgent commentary. And that absence was not accidental. Major financial shifts often begin outside public attention. When markets move under cover of silence, it allows large players to adjust positions without triggering panic. The lack of coverage was not a sign of irrelevance. It was a sign of early stage. By the time something becomes news, it is usually already late. Who actually noticed? Retail buyers noticed inconvenience. Professionals noticed confirmation. Industrial users, institutional allocators, and long-term accumulators understand that when physical access tightens, paper prices lose authority. They don't react emotionally, they observe. And what they observed on Christmas Day was simple. Dealers were no longer comfortable selling silver at posted prices. That single fact carries enormous implications. Why Christmas Day was the perfect moment. If this had happened on a regular trading day, questions would have been asked, social media would have reacted, volatility would have accelerated. But Christmas Day neutralized attention, a signal for what's next. So what does this pause actually indicate? It doesn't mean that silver is gone or that a crash is inevitable. Instead, it points to three crucial realities. Selling at posted prices had become risky. The gap between paper and physical markets made transactions potentially costly. Replacement costs were rising and uncertain. Dealers were effectively defending their margins. The next phase of price discovery was imminent. This pause set the stage for future volatility. History demonstrates that strategic pauses often precede major moves. What appears as inactivity is actually a calculated positioning strategy by sophisticated players. The decision was logical. Dealers' choice to stop selling was rational and professional. It was not panic, it was discipline. Avoid selling at unfavorable prices, prevent losses due to market misalignment, maintain credibility and operational stability. This move silently communicated to professionals watching the market. Something important is unfolding. For retail buyers, the pause may have seemed confusing or frustrating, but for experienced traders, it was a signal of underlying stress in the system, setting up the next phase. Part 1 explored what happened, the sudden Christmas Day halt. Part 2 has explained why it happened, the rational risk-based decision-making behind dealer behavior. But the real story lies in the specific market levels that triggered this pause. Dealers were not acting randomly. They were responding to a critical pivot point in silver pricing, a level that dictated whether selling was safe or too risky. That number, quietly observed across markets, is one every serious silver investor is watching. $126. In Part 3, we will dive into the $126 pivot, what it means, why it matters, and how it could shape the next phase of silver markets. In the chaos of global markets, numbers often speak louder than words. And for silver on Christmas Day 2025, 126 wasn't just another price. It was a line in the sand, a threshold that dictated the behavior of dealers, institutions, and even industrial buyers. While retail investors were focused on availability and delayed deliveries, professionals had their eyes locked on this critical pivot. Understanding why requires a deep dive into market mechanics, risk perception, and historical precedent. The concept of a pivot. A pivot in markets is more than a technical term. It represents a price level where market sentiment shifts. Above it, buyers feel secure and sellers are willing. Below it, hesitation grows and risk dominates. In silver's case, $126 became that pivot. Multiple factors combined to make it critical: historical price resistance and support. Silver had repeatedly tested the $126 level in the prior months, and each time it either bounced or corrected sharply. This created a psychological as well as technical barrier. Hedging imbalances. Futures contracts around this price were unusually thin, making sudden movements risky. Dealers could be caught on the wrong side of contracts. Premiums on physical metal. In the physical market, $126 represented the threshold where premiums for bars and coins would spike dramatically. When all three elements converge, it isn't merely a number, it's a market signal. Why dealers feared crossing $126? Dealers, by nature, manage risk, not just inventory. On Christmas Day, with thin liquidity and elevated volatility, the decision was simple yet profound. Selling below $126 could trigger margin risk, as hedges might fail to cover costs. Pushing transactions above $126 risked market backlash, accusations of price manipulation, or simply losing buyers. The gap between paper and physical pricing widened as $126 approached, creating an asymmetric risk environment. In essence, $126 represented a point of no compromise. Dealers who had historically sold at or near this level suddenly found themselves frozen, not by logistics, but by strategy. The psychology behind the pivot price levels are as much psychological as they are numerical. Experienced traders know that thresholds like $126 create a shared consciousness across the market. Buyers hesitate to purchase above the pivot, fearing overpayment. Sellers hesitate to liquidate below the pivot, fearing undervaluation. Institutions monitor the level closely, ready to act if breached. The Christmas Day halt wasn't random. Dealers and institutional players were responding to collective market psychology as much as to spreadsheets. They recognized that moving past $126 without clarity could trigger unpredictable reactions, including panic buying or rapid price swings. Historical parallels. $126 didn't exist in isolation. Historical analysis shows multiple instances where critical price levels shaped market behavior. Silver in 2011. When prices reached near $50 Oz, a pivotal threshold triggered a frenzy of both retail and institutional buying. Futures contracts dislocated from physical availability, much like what happened with $126. 2008 financial crisis. Gold and silver each had key pivot points that dictated hedge fund behavior. Crossing those points meant immediate margin adjustments and forced inventory rebalancing. 2020 pandemic squeeze. As physical silver became scarce, specific price pivots caused dealers to halt sales temporarily, mirroring the Christmas 2025 scenario. $126 in this context was not arbitrary. It was the modern iteration of a historical pattern. Markets create invisible barriers where rational participants pause, recalibrate, and wait. The role of futures and paper markets. To fully understand $126, we must look beyond the physical market. Silver futures contracts, traded in Chicago and London, define paper silver pricing. Dealers use these contracts to hedge, protecting themselves from price swings. But when paper and physical markets diverge, something that becomes extreme near pivot points, the hedging model fails. Futures at $126 could show stability. Physical silver, driven by supply constraints and rising premiums, effectively cost more. This discrepancy meant that continuing sales at 126 could result in instant losses for dealers, even if the public perceived prices as stable. The pivot acted as a stress test for the system. Impact on retail and industrial buyers. For everyday buyers, $126 was mostly invisible. They only noticed unavailability. But for industrial buyers, every fraction of a dollar mattered. Electronics manufacturers need predictable delivery costs. Solar and medical industries monitor premiums closely. Institutions adjusting portfolios watch these thresholds to optimize risk. The Christmas shutdown around 126 created a temporary freeze in allocation decisions. This pause allowed dealers and institutions to prepare for what could happen once the pivot was breached. $126 as a market signal. In simple terms, 126 communicated three messages. Risk exists. Dealers are unwilling to sell at current valuations. Price discovery is paused. The market cannot reliably determine the fair value under current conditions. Next moves are imminent. A breach of $126 in either direction would trigger significant activity. History teaches that such pivots often precede explosive movements. Markets rarely stay at the pivot long. Either buyers eventually overpower sellers, pushing prices higher, or the system recalibrates downward. Why professionals watch this level. 126 was not just a number, it was a warning flag for professionals. Experienced traders, hedge funds, and industrial buyers monitor these pivot points daily. If the pivot holds, the market stabilizes temporarily. If it breaks, rapid price adjustments follow. Futures, physical premiums, and hedging models all react simultaneously. This made the Christmas Day halt more than operational. It was strategic positioning. Dealers were essentially saying, we cannot move until clarity emerges. Implications for the future. The 126th pivot is critical not just for December 25th, but for the weeks and months ahead. It defines the safe operating range for dealers and institutions. It dictates premium fluctuations for physical silver. It signals potential volatility spikes in the near term. For retail investors paying attention, it also serves as a lesson. When prices approach critical pivots, supply disruptions are often a leading indicator, not an anomaly. Setting the stage for Part 4. Understanding the 126th pivot completes the why behind the Christmas Day shutdown. But numbers alone don't tell the full story. The real impact is felt when we examine how this pause affected markets, trading psychology, and investor behavior. Part 4 will explore the immediate and short-term effects on silver prices, institutional and retail responses, the historical significance of silent shutdowns, and ultimately, we'll see why 126 is more than a number. It ends a signal for the next phase of the silver market. The Christmas Day shutdown and the $126 pivot were not isolated events. They sent ripples through the entire silver ecosystem, affecting dealers, institutions, industrial buyers, and ultimately retail investors. Part 4 explores the immediate consequences, market reactions, and historical patterns that contextualize this unusual pause. The immediate impact on silver markets. When multiple bullion dealers simultaneously halted sales, the first effect was availability panic. Retail buyers noticed scarcity almost instantly. Websites showed out-of-stock messages. Coin premiums surged quietly in smaller markets. Physical silver became harder to source for those looking to purchase in bulk. While mainstream attention was low due to the holiday, volume constraints triggered subtle price shifts in futures markets. Futures traders observed that liquidity had thinned, causing small orders to move prices more than usual. Institutional buyers were forced to pause, reevaluate hedges, and reprice positions. This kind of simultaneous reassessment rarely happens outside crisis scenarios, and it signaled underlying instability even without visible price spikes. Professional reactions. Unlike retail investors, professional players, hedge funds, industrial buyers, and market makers reacted quietly but decisively. Hedge funds monitored paper versus physical price gaps. A widening gap indicated potential profit opportunities, but also risk if markets shifted unpredictably. Many funds temporarily reduced open positions. Industrial buyers, companies relying on silver for manufacturing, had to adjust procurement strategies. Sudden unavailability risked production schedules, leading to early ordering from alternative suppliers at higher premiums. Market makers paused aggressive quoting to protect margins, ensuring that any sudden price jumps wouldn't create large exposure. This collective restraint caused a temporary vacuum in market activity, highlighting how systemic the impact of a single pivot and pause can be. Retail psychology and the silent signal. For everyday buyers, the pause appeared confusing or frustrating, many were left wondering if silver was gone or if the websites had technical errors. But the experienced eye reads such events differently. A synchronized halt on a low liquidity day is rarely a coincidence. It signals that the market is preparing for a shift, even if the public hasn't noticed yet. Retail psychology often lags behind institutional moves. While professionals see a calculated pause, retail buyers may misinterpret it as scarcity, creating delayed but sometimes explosive demand once supply returns. This pattern has repeated throughout silver history. Historical parallels. Silent shutdowns. The 2025 Christmas Day event fits within a long history of similar patterns. Historical analysis provides critical context. 1. 1971, gold and silver realignment. When the U.S. decoupled the dollar from gold, bullion dealers experienced extreme uncertainty. Many temporarily paused sales, waiting for price discovery to stabilize. Paper and physical markets diverged, creating premium spikes and short-term scarcity. 2. 2008 financial crisis. During the early stages of the crisis, physical silver and gold became hard to source. Dealers paused orders in multiple locations, waiting for clarity in futures and industrial contracts. Low liquidity magnified the effects. 3. 2020 pandemic squeeze. When COVID-19 disrupted supply chains, silver experienced both paper price surges and physical shortages. Dealers restricted sales quietly, allowing institutional players to accumulate positions without triggering public panic. This mirrored the Christmas Day 2025 behavior closely. Across these events, the pattern is clear. Silent, strategic pauses often precede explosive price discovery. Physical vs. paper markets, amplifying the impact. The Christmas halt and $126 pivot highlighted the ongoing tension between paper silver and physical silver. Paper silver. Futures contracts appeared stable but were thinly traded, making prices sensitive to small orders. Physical silver. Supply constraints caused premiums to rise independently, signaling real-world scarcity. This divergence created asymmetric risk, forcing dealers to halt sales until the market could realign. The temporary disconnect is particularly important because it can foreshadow larger market moves once liquidity returns. Industrial and institutional implications. Industrial buyers faced immediate challenges. Electronics, solar, and medical industries rely on predictable silver supply. The temporary halt forced procurement teams to adjust contracts and source alternative suppliers. Institutions adjusting portfolios reacted cautiously. A breach of the $126 pivot would trigger rebalancing and hedge adjustments, potentially creating volatility in both physical and paper markets. The ripple effects extended beyond December 25th, affecting supply chain decisions and pricing strategies into the following weeks. The silent signals long-term effects. The Christmas shutdown wasn't just a short-term pause. It was a signal for what comes next in silver markets. Volatility was about to increase. Thin liquidity and market imbalance set the stage for sudden moves once trading resumed fully. Premiums for physical silver could remain elevated. Scarcity created pricing pressure, especially for coins and bars. Retail behavior would lag behind. Once public attention returned post-holiday, demand could spike sharply, amplifying price movements. By halting sales, dealers effectively bought time and clarity. Institutions, aware of the pivot, were quietly adjusting positions in anticipation of larger moves. Market patterns and context. When viewed historically, events like the Christmas shutdown fit into a clear pattern of strategic pauses. Pre-2011 silver bubble. Dealers paused and adjusted supply quietly, setting up the rapid run to historic highs. 2008-2009 crisis. Dealers' temporary halts allowed institutional players to accumulate, creating a delayed but dramatic price spike. 2020 pandemic. Physical silver scarcity led to a temporary disconnect from paper markets, followed by record premiums and institutional positioning. In each case, the market pauses first, explodes later. The Christmas Day halt of 2025 fits neatly into this historical precedent. Lessons for investors. For those watching, Part 4 provides clear takeaways. Strategic pauses matter. Not all inactivity is benign. In silver markets, pauses can indicate preparation for significant moves. Pivots dictate behavior. Critical price thresholds like $126 influence institutional and dealer decisions more than public perception. Retail psychology lags. While professionals respond instantly, retail investors may only react after the initial movement, potentially amplifying volatility. Understanding these dynamics allows a more informed approach to silver investing, avoiding knee-jerk reactions to superficial scarcity. Setting ups. Part 5. What comes next? With Christmas Day halted sales, the $126 pivot as the central threshold, and historical parallels highlighting the importance of strategic pauses, The stage is set for the next chapter of silver markets. What happens when the pivot is breached? How will dealers, institutions, and industrial buyers react? What signals should retail investors watch closely for? Part 5 will explore future scenarios, potential market moves, and strategic takeaways, concluding the story with a powerful summary and viewer call to action. The Christmas Day halt in silver sales, the critical $126 pivot, and the historical context of silent market shifts have set the stage for the next chapter in silver markets. By now, it is clear that this pause was not a random holiday anomaly. It was a deliberate, calculated response to a fragile market, signaling that the next moves could be swift, significant, and unpredictable. Understanding what comes next requires examining potential market reactions, investor psychology, and systemic trends. This is where the story transitions from observation to anticipation. 1. The immediate scenarios. Once trading resumes fully after the holiday, there are several possible scenarios. A. The pivot holds. If silver maintains levels around $126 without significant breaches, dealers regain confidence and resume sales gradually. Industrial buyers return to normal procurement schedules. Premiums for coins and bars stabilize. In this scenario, the Christmas pause serves as a reset, allowing the market to digest prior volatility and align physical and paper pricing. Institutional players may continue to accumulate quietly, but the public may not immediately perceive significant change. B. The pivot breaks upward. If silver breaches the $126 pivot upward, dealers who paused may re-enter aggressively, adjusting prices in real time. Premiums for physical silver surge as supply meets heightened demand. Retail investors who previously hesitated may rush to buy, amplifying upward momentum. History shows that such breaches can trigger rapid repricing, sometimes within hours or days, as both physical and paper markets realign. Hedge funds and institutional buyers often profit, while late entrants face elevated costs. C. The pivot breaks downward. If silver falls below $126 decisively, dealers and institutions may tighten supply further. Risk aversion spreads through the market. Retail and industrial buyers may delay purchases, anticipating lower prices. Downward breaches tend to be slower but more strategic, as institutions look for opportunistic accumulation while managing exposure to losses. 2. The role of institutional and industrial players. Professional players have already positioned themselves for post-holiday volatility. Hedge funds monitor real-time price divergences, ready to exploit gaps between futures and physical silver. Industrial buyers recalibrate procurement strategies to avoid supply shocks. Large accumulators anticipate scarcity, quietly building positions at favorable levels. This coordinated but silent activity creates hidden pressure, which often becomes visible only after retail markets respond. For casual observers, sudden price swings may appear out of nowhere, but in reality, they are the culmination of carefully calculated moves. 3. Retail impact. For everyday investors, the Christmas shutdown and the $126 pivot serve as an early warning system. Short-term buyers may experience frustration or scarcity, particularly for coins and bars. Long-term investors should note the strategic nature of dealer pauses and view them as signals, not panic triggers. Opportunity emerges. Historical patterns suggest that moments like this precede significant upside potential for those who understand pivot dynamics and market psychology. The key lesson for retail participants is patience and observation. Reacting emotionally to temporary scarcity can result in overpaying, whereas understanding systemic patterns allows for informed decision-making. 4. Historical context. Revisited. The Christmas Day halt is not unique. It fits a consistent historical pattern where strategic pauses foreshadow market moves. 1971, gold and silver realignment. Dealers paused to manage risk as the U.S. abandoned the gold standard. 2008, financial crisis. Temporary halts allowed institutional players to accumulate before major volatility. 2020, pandemic squeeze. Physical silver scarcity drove premiums and created divergence between paper and real markets. In each case, the silent moments were followed by rapid repricing, often taking the market by surprise. The lesson is clear. Do not underestimate low visibility periods. They're often the calm before the storm. 5. Strategic takeaways for investors. The Christmas shutdown and $126 pivot offer several key lessons for anyone tracking silver. Pay attention to pivot points. Critical price levels can dictate dealer behavior and market sentiment. Observe dealer actions, not just price charts. Pauses, unavailability, or silent inventory shifts often signal strategic positioning. Understand market psychology. Professional players react differently than retail buyers. Patience and context are essential. Monitor both paper and physical markets. Discrepancies between futures and real-world supply reveal systemic stress. Expect volatility after quiet periods. Historically, strategic pauses precede rapid moves in both directions. By integrating these principles, investors can make more informed decisions and avoid overreacting to temporary scarcity. 6. The future of silver markets. Looking ahead, several trends are likely. Institutional accumulation will continue, quietly adjusting positions while retail attention remains low. Premiums for physical silver may rise, particularly for coins and small bars, reflecting real-world scarcity. Volatility around critical pivots will increase, especially if macroeconomic uncertainty grows. Retail investors who act impulsively risk buying at peaks. Those who observe may find strategic entry points. The Christmas shutdown and $126 pivot are not just isolated events, they are signals of a deeper systemic recalibration in silver markets. 7. Conclusion. Silence speaks. December 25th, 2025 will likely be remembered by professional traders as a moment of strategic insight. While the world celebrated holidays, dealers and institutions paused, observing the 126 pivot, assessing risk, and quietly preparing for what comes next. For retail observers, the event offers a rare lesson. Markets often communicate through silence, not headlines. Understanding these signals can be far more valuable than reacting to visible price fluctuations. The takeaway is simple. Dealers pause for a reason. Pivot points dictate risk and opportunity. Historical patterns repeat themselves. Strategic patience beats impulsive buying. 8. Call to action. If you found this deep dive into silver markets, Christmas Day halts, and the $120 pivot insightful, make sure to like this video. Subscribe to Hidden History Vault to stay updated on the stories behind the headlines, where history, finance, and strategy intersect. Hit the notification bell so you don't miss the next analysis on critical market signals that rarely make mainstream news. Remember, in finance, as in history, the quiet moments often tell the most important stories. And that brings us to the end of our deep dive into the Christmas Day silver shutdown and the 126 pivot. From the unexpected halt in sales to dealer risk management, the strategic importance of the $120 level, and the historical parallels that show how silent pauses often precede major market moves, it is clear that this was not just a holiday anomaly. It was a calculated signal, a glimpse into the forces shaping silver markets behind the scenes. For retail and professional investors alike, the lessons are invaluable. Watch the pivots, observe dealer behavior, understand market psychology, and never underestimate the silent signals. If you found this analysis insightful and want to stay ahead of the hidden stories shaping finance and history, make sure to hit the like button, subscribe to Hidden History Vault, and turn on notifications. That way, you won't miss the next deep dive into the events that rarely make the headlines but have the biggest impact. Remember, history speaks quietly, but it always leaves a trace. Thanks for watching, and we'll see you in the next one.